Thomas, interest rates in the news. So they were really low, then they got a little higher in the past few months and got kind of a little higher, and now looks like we had another rate cut. What do you think?
Oh, yeah. So you're talking about the federal funds rate. And just before going into the two things that I think will lead probably to higher mortgage rates in 2020, I think it's important to make a distinction between, right, what central bankers or the Federal Reserve, the European
Right.
Central Bank, those are the two big kings of finance, right?
Absolutely. So, Thomas, this is good because people do not really know that the Fed does not control mortgage rates. The rate you pay on your mortgage, when you hear the Fed is raising rates or lowering rates, they only indirectly influence the mortgage market. Tell us about that if you would.
Yeah, so if you go back to 2015 and 2016, most traders in the market thought, hey, the Fed's starting to raise rates. They haven't been doing this for a long time. When they raise rates, mortgage rates should go up, right? But that's not what happened. The Federal Reserve started raising the short term interest rate, known as the federal funds rate, and mortgage rates dropped. And the reason being is the Fed doesn't control the mortgage rates. The mortgage rates respond more to what expected inflation is going to be. And the Fed can indirectly influence what the inflation will be, but not really. They don't have a whole lot of control over that. It's more macroeconomic factors that are beyond central banks' control, beyond policymakers' control. That's what the mortgage rate responds to. The two central bank factors that I was thinking of that may drive the mortgage rate higher in 2020,
Yeah,
at least they'll put upward pressure on the mortgage rate.
right. And I just want to say, as I've said many times to the listeners, I absolutely suck at predicting interest rates. I have tried. I thought they'd be higher, from many years ago. I thought that. And they should have been higher. I would have been right if we actually had a free market in this type of thing, but we don't. We have all these powers that be, if you will, that, they don't follow the rules of supply and demand, inflation, all that kind of stuff. I don't know. You could disagree with me, Thomas, of course, but I just think that rates definitely should have been higher from a long time ago. They're just artificially low, in my opinion. But you think they're going up next year. Why do you think that?
I think mortgage rates are going up next year, and I think you're right. If you're talking about the federal funds rate, so back in 2014, the economy was doing really well. Well, really well is a relative term, right? Because the recovery was weak. But the economy was doing well enough to where the Fed could have started raising rates back in 2014, but they didn't. They waited even further. And I think that hesitancy to act has led us to where we're at now, where rates are still quite low. The federal funds rate, central bank interest rates is what I'm referring to. And they tried to get them up a little bit, but now they're coming right back down. I can't see at the current point where we're ever going to get away from low interest rates
Yeah,
at the central bank level.
it is. And, this is what some call financial repression because those low interest rates really do hurt a lot of people, especially older people with savings that plan to live off the interest on that savings. And they just can't do it. So they're pushed into more risky investments and things that they really shouldn't be doing at their age. They should be able to just ladder some CDs and keep it simple, but it's not the world we live in, sadly. So I don't know how we can ever see rates that are a lot higher. We would have to have a real huge inflationary concern to see, rates into the 15%, 18% interest rates like we had in the Jimmy Carter era, or at least from the Jimmy Carter hangover. Reagan inherited a little bit of that. What do you think?
I agree. I do think that in 2020, the conventional wisdom right now is that inflation's probably coming down because of slower economic growth. But my guess is the flip happens. Inflation is probably going to come back up. The economy right now is going through a mid-cycle slowdown. But my guess is inflation comes back, and there are two central bank forces that are going to push inflation back up. And the first is money printing. So in 2019, money printing took a breather. After years of lots of printing of money by central banks, right? It's called high power money. They just printed money out of nowhere. By saying printing money, meaning they pushed a computer key.
It's not really printing.
From 2018 to 2019, the total money supply across the world probably dropped by around 315 billion.
Say that again.
By around 315 billion.
In
So
what time frame?
most of, from 2018 to what I'm expecting the final 2019 values will be.
Okay, so in the course of a year, the money supply, global money supply, contracted by $315 billion, you say?
That's what I'm expecting.
That's not really that much, though, is it? I mean, and does that include, we used to have M1, M2, M3. They took one of those away, but, it's really, are you including the supply of credit in that or money? Like, what do you call the money supply? There are different ways to look at that, obviously.
Yeah, you're referring to the formal definition of money supply, and
Right.
I should refer to the formal. What I'm referring to when I'm saying money supply in this context is really central banks' balance sheets, which are basically, in the Federal Reserve's case, the Treasury securities that the Federal Reserve holds. It holds other securities as well, but the vast majority of what the Federal Reserve owns on its balance sheet is Treasury securities. So when I say the Fed's balance sheet will drop and central banks' balance sheets will drop across the globe by 315 billion, I'm referring to, say, the Federal Reserve's holdings of Treasury securities will drop from, say, 4 trillion to 3.8
Okay, so I
trillion.
just want to I always teach our listeners to ask themselves the question, compared to what? So if you compare that decline in money supply in terms of those central bank balance sheets around the world, it doesn't seem like that much to me because the global economy is somewhere around, the GDP of the planet is somewhere around $60 trillion, trillion with a T. So 315 billion is like a third of a trillion. So I don't know. Is that significant?
I think it matters on the margins for mortgage rates
Hmm.
because mortgage rates are responding to what it thinks inflation will be. And inflation responds to central bank purchases of government securities. So,
Fair enough.
yeah, if the Fed's out there buying 10-year notes from the Treasury, that puts downward pressure on the yield of the 10-year note, which may in effect also affect the mortgage rates.
Okay, got it. So, Thomas, the prediction is higher rates next year. That's very significant for real estate investors, obviously.